Welcome everyone to the second Bell Asset Management webinar for 2023, the compelling case for Global SMID Cap Equities. Matt, if we can just click to the disclaimer page, that'd be great. Just read this in your own time, everyone. I'm James Biggins. For those of you who don't know me, I'm a director at Channel Capital, and today I'm joined by Ned Bell, CEO of Bell Asset Management. Ned runs a number of strategies, but the two we're focusing on today are the Bell Global Equities Fund and the Bell Global Emerging Companies Fund. Again, as always with all Zooms, please submit your questions throughout the presentation. And if we don't address them today, we will come back to you at some point in the time. This webinar will aim to run till 1:15 p.m. And yeah, please submit your questions throughout. Welcome, Ned. I thought it might be worth starting with a market outlook and looking through your expectations across a few of the strategies that you run, but specifically on global equities, SMID, for the back half of 2023 and beyond.
Yep, great. Thanks, James, and thanks everyone for joining. So we'll put a couple of slides here to really get to try and frame up our view in terms of the markets looking forward. And that does need a bit of context in terms of what's happened for the first 6 months of the year. So what's particularly evident is that what you call the rally of the global equities markets this year has been really dominated by 7 stocks. You know, some people call it the Magnificent Seven. And those names there, they represent a bit under 20% of the benchmark, but they've accounted for about half the return. So that is quite abnormal, quite unusual. But then I think one of the interesting things that gets us a bit more excited about the ability to still generate alpha in markets is that the rest of the market, if you like, the other 80-odd% has, for the most part, lagged. You've only had 34% of those names have outperformed. And of those names, on average, they traded about an 8% discount to their 5-year average, which I think is pretty interesting because there's a pretty a pretty common theme in the market that the market is expensive. And I don't think that's necessarily the case. It's really just the idea that a certain part of the market has become very expensive. Those stocks, last time I looked, they're trading on a forward PE of something like 30, I think it's 38 times earnings. It was about 22 times earnings for those stocks in December of last year. And that's another really important point. You've really seen the bulk of the return that you've seen in those names has been driven by multiple expansion more so than earnings growth. And that's important because it draws a bit of a spotlight on the sustainability of the rally that they've had. And I'm sure everyone's going to expect me to say this, but what does this mean for investors looking at particularly the small mid-cap asset class? The market, in a way, is just giving you, in our view, another gift, another opportunity to take a bit more profit in those companies. And again, there's nothing wrong with the companies. They're terrific companies, done a great job, but they are well and truly overpriced here. The question we get, and you might be asking yourselves, is so what about small mid cap? Why has it lagged? Why has it lagged the last couple of years? And the first thing I always tend to do is to go back to the underlying earnings performance of the asset class and say, what has it done? Have the earnings actually grown? And what history tells you is that particularly from that 2018 to 2022 period, the earnings growth has been exceptionally strong. It's actually outgrown that of the MSCI World Growth Index. But you've seen, obviously, tough performance. You've seen multiples go the other way. So PE multiples have actually retraced from about 19 times to about 15.5 times. So it's very unusual that you see a situation where multiples contract at a point when earnings growth has actually been very, very strong. So those are a couple of key points. I mean, just the following page, Matt. I think the other topic we talk about a bit is really just focusing on this idea of the style that we operate in. So we're quality investors, and again, we do feel pretty strongly that the quality style is set up very well for a prolonged period of outperformance. There's a slide we'll get to a bit later that just sort of demonstrates that quality does, for the most part, outperform pretty solidly during periods of high inflation. And as much as we might have seen peak inflation, it seems less and less likely that it's going to come back to that, that 2% band. The Fed is forever hopeful that it will. And hence, we still remain quite bullish that quality will do well. And then when it comes to the upside, we often get asked the question, well, what's the upside in the asset class of SMID if you're allocating today? And to think through sort of a simplistic way of methodology thinking about the upside, at the moment it actually trades on a multiple of about 15.5 times. If you were to sort of assume that might re-rate by about 2 PE points in the next 12 months, which isn't too much of a stretch, and the consensus number for 2025 holds, there's basically about 36% upside. So that's a pretty big, it's a pretty big level of upside given where markets are now. And I think that's the important thing, because everyone's asking themselves the same question. Markets are at their highs, feels like it couldn't get any better, doesn't feel like the market's pricing in any negativity at all. Where's the upside from here? SMID does remain sort of this, I guess, pocket of opportunity that has lagged for the last 5 years, but we do feel that it's just a matter of time before it does start to play catch up. So it's a long answer to your first question, James, but hopefully I've hit some of the key points.
No, it's very detailed, and I think you mentioned in your first response just around those handful of names that have driven the market higher, and as we've referred to the elephants in the room. But I think it's really important for people to understand, what they've been given as that kind of gift to maybe look to sell down and change their allocation. So if you could just expand that a little bit more, that'd be great.
Yeah. So so again, these 7 names, as they've, obviously as they've performed the way they have, their percentage of their index representation that has become bigger and bigger. But I think when you look at the size of those 7 companies relative to the entire small mid cap index, they're getting closer and closer together. So those 7 companies account for roughly $10.9 trillion US dollars versus the entire small mid cap index of 15.2, which is quite extraordinary. And just a reminder that MSCI defined the small mid cap sleeve of the market as the bottom 28%. So it's you're getting that top end of the market is getting very, very top heavy, and it feels like there just needs to be some mean reversion before too long. And as I've touched on there, you can see that the PEs have expanded very considerably and are now roughly double that of the benchmark, which I think is interesting. And I guess another question we get is, so what's the catalyst? What's the catalyst that could see some these names start to give back some of their recent gains? One interesting one is actually happening as we speak, which is the rebalancing of the Nasdaq index. So so Nasdaq have got a rule in place whereby I think from memory it's the top 7 names in the index can't represent more than 50% of the index. It's now over that number. So there's a Nasdaq rule that is forcing them to readjust those weightings down. And from memory, I think they account for 56% of the Nasdaq 100 now. And Goldman put out a report saying the expectation is that'll come down to about 44. So then the question becomes who's the marginal buyer of these names at these levels? And that's where I'm not sure there's a lot of active money would be sort of piling into these names after the rallies they've had.
Yeah, no, that's fascinating. I didn't know about that Nasdaq index ruling, so that's quite fascinating. I think taking it to the next, or going a little bit further, looking back over the first half, can you talk through, which I think is really important, is that even though those fabulous 7 or magnificent 7 have driven the names higher, we've also been able to generate some strong returns, but obviously in names that aren't, well known, or they might be well known, but people might have missed out on them. So it'd be good to kind of explore both in the large cap and the SMID cap some names where we're seeing value, and that's generating into alpha across the portfolios.
Sure. Yeah. So we put a slide together to I really just to highlight the idea that, I mean, to your point, there's more to generating performance than just those names and just anything that's got any resemblance to the AI theme. There's been a couple of different sort of pockets of performance within our portfolio from a large cap and from a small mid cap perspective. I mean, clearly we've had some exposure in the large cap space to the likes of, Microsoft, Google, have obviously done very, very well. But we've also had probably some of the more the software stalwarts, like the SAPs and the Oracles, that were probably considered a bit more in the value camp for quite a while, have had remarkable performance this year. In the semi space, ASML, again, clear leader. Their global leader, been a terrific performer. And then in the luxury space, if you recall, in Q4 last year, the luxury names were in a bit of a slump. We were dialing up our positions at that point. We thought they'd been oversold, and lo and behold, the optimism around the China recovery story really sort of took hold, and the likes of Hermes and LVMH have been spectacular performers. And then again in the healthcare space, I mean, the likes of Edwards, HCA Healthcare, the big hospital company, have been terrific performers. And then, shifting back to the small mid cap names, again, some similar themes. But I think the point is that, like, those names on average, I mean, we've made a bit over a 30% return in those names. And some of them are a bit more akin to the consumer, skewed towards the consumer rebound. So the likes of Thule, Bullcorp, Fortune Brands would be names that last year were some of our laggards. And the view on those names last year was very much, now the COVID rebound is over, the earnings are going to fall in a hole. That didn't really happen. You definitely saw growth come off somewhat. But I think, the market's now looking through that and looking towards a period of normalisation and recognising that the companies are still pretty strong. Again, in the healthcare space, the likes of Icon, IDEX being terrific performers. Arista, one of our best performing tech names. Montclair has been a fantastic luxury story for a number of years. So again, a lot of different stories, driving the performance of the funds, which is important because we're big believers in that. We don't want to sort of bet the house just on one or two themes, only to see those themes come completely unstuck. So it's been really pleasing to see that there are different parts of the portfolio generating alpha in the first half of the year.
And I think further to that, our focus on quality as a style has really delivered, or has delivered in the past in higher, inflationary environments, and it still feels that we're still in a bit of a higher inflationary environment as we speak, even though some of those metrics are starting to fall away. But it'd be good to kind of refresh people's memories around, why quality is a style today and going forward.
Yep. So we put this as the slide I was referencing earlier. And so the purpose of particularly the table on the left just shows how the MSCI Quality Index has performed in a relative sense during those calendar years when US CPI has been north of 4%. So we've used this chart a bit, so apologies if you've seen it already. But I think that the point is that there is a very close correlation, that the quality factor outperforms on average by 7.4% in those calendar years. And there haven't been too many periods when that hasn't held true. 88 and last year with the two. But if you look at 1988 and the subsequent years from there was obviously a very strong period of quality outperformance from that point on. Now, if we fast forward today, we have seen quality as a factor do pretty well for the first half of this year. However, what I would say is that has been very heavily skewed towards a handful of those mega cap names, particularly Apple. Because some of those elephants, if you like, collectively represent a very large part of the MSCI Quality Index. So it's not necessarily, while quality's outperformed, the rest of what we would regard as the quality universe hasn't outperformed to the extent that it first appears when you just look at the performance of the indices. And there's parts of the broader quality universe, particularly in healthcare and consumer staples, that have lagged quite materially and are now looking very, very compelling from a valuation perspective. So we feel like that, I guess, that quality rebound journey, we're still very early on in that, and it's been dominated by a handful of names. So I think that's kind of where we are. And then obviously growth has caught fire again this year. Seen massive outperformance of 10% or more, and the poor old value groupers had another rough 6 months after a good year last year. But yeah, we feel like quality's poised to do well. And then just one point I'd make is that we often get this is like, well, why do we feel inflation is going to stick around? And it comes back to the employment market in the US, which is just stubborn, and it's just very it's a very sticky type of inflation that hasn't really changed much. And so until you see the situation, or if you see a situation where you see a lot of layoffs, we just don't really see that inflation, that employment part of the inflation picture abating anytime soon.
Yeah, no, that makes a lot of sense. I think that's kind of a global phenomenon, just that strong employment numbers. Now, switching gears, the title of the webinar was a compelling case for SMID. Mm-hmm. And I know I've used this slide a little bit through the last handful of meetings that we've had with clients and also webinars, but Ned, it'd be really good to kind of, demonstrate where we are and that opportunity in your comments around in the first 5 minutes that we do see SMID still offering a lot of value for clients, and especially with the free kick that they've probably been given with some of these large and thematic themes like AI, giving them, ability to kind of switch into another asset class or expressing growth in another way.
Yep. No, exactly. And again, we've used this chart before, but it's actually become more compelling, the valuation differential, particularly the chart on the left. We've seen the performance, the recent performance, or the PE expansion of the growth index has been quite remarkable. It's really gone in one direction, whereas the multiple of the SMID Cap Index has really drifted. So that gap, it's almost like a rubber band effect, where it's just being stretched a little bit further. And to my earlier point, the actual delivered earnings growth has been quite a bit better in smalls and mids. So valuation is very compelling. The valuation, I guess, discussion in the mega caps is, I'd say they're getting into they're almost redlining in terms of how expensive they're getting. And so I think they're getting more and more prone to a bit of a pullback. And the natural, or one of the natural and very obvious places to reallocate to is in the smaller end of the market, where they've just not kept up. And so we feel that's and again, we've obviously been talking about this argument for a little while, but we do feel that there's the more we sort of move into the year, there are more and more catalysts lining up to see that snapback occur. And I think another catalyst to think about in the case of small mid-cap names and what might actually get them going is the idea that, generally markets, they're discounting mechanisms. They're always discounting what's going to happen 12 months from now. So in 12 months from now, we're going to be talking about inflation should be, hopefully a couple of percent lower. We'll hopefully be into 4 or 5 rate decreases by then, hopefully, pricing in another 1 or 2. And at that point, when you start seeing, interest rates coming down the other side of the mountain, it's hard to see how the multiples just don't expand. It's hard to see how you don't see multiple expansion in the SMIDs. It's also hard to see how you don't see a better revenue growth environment for the small mid-cap companies, which has been, frankly, the last couple of years, it's been tough. There's not, at the risk of stating the obvious, since COVID, these small mid-cap companies from a revenue perspective have had, obviously, the COVID year. You've had, war in Ukraine. You've had hideous inflation, 5% interest rate. They've had a lot thrown at them, and it's all been pretty bad. And I think, when you start to see, there's some green shoots that'll appear in the first half of next year that'll start getting priced in our view in the second half of this year. So we feel, probably more optimistic than ever that the asset class itself is poised to do, really, really well over the next, probably 2 to 3 years.
Great. And I think it's important to kind of, when we're thinking about SMID and people potentially making that move from, an all cap or large cap allocation to a SMID, just to kind of, what are they actually buying? And, is it diversified? Is it concentrated from an index point of view? But then also, how do we think about SMID and how do we define it? I think is really important as well. So if you could just share some thoughts on that, that'd be ideal.
Yep, sure. So in terms of defining the asset class, so MSCI have got a slightly odd way of doing it. They define it as, they conduct the index by taking the bottom 28% of each country and putting it together. And the problem with that is the market cap cutoffs are all a little bit different. So we apply that same threshold to the MSCI World Index. So irrespective of where a company is based, it's the same threshold. So it's essentially up to a market cap range of 41 billion US dollars. So materially larger than the Aussie market, but it gives us, a big universe to play with. And I think it probably is a little bit different to some other interpretations of this asset class. So, some strategies in this space might define the asset class or, as being said, anything up to that 10 billion market cap, and that's it. And then when they hit 10 billion, they sell the stock. Now, our experience has been the best time to own these companies is when they're between 10 and 40 billion. That's when they've gone through their adolescent period. They've stopped burning cash. They don't need to keep going back to capital markets. They've probably got a bit more maturity about the way they're managed, and they've still got a pathway of growth. So that sweet spot between 10 and 40 billion is something that's, we feel a little bit unique about the way that we look at this asset class. And again, when we look at our performance, attribution over a long period of time, a lot of it has come from that companies when they're in that range of 10 to 40 billion. From a geographical and sector perspective, so we're only investing in developed markets here. I would say that from the sector perspective, it is a bit more diverse in terms of the names. It's not just a one-trick pony on IT and AI names. I mean, there's a lot of very good healthcare names, financials, in the consumer space. We've had great performance there. So it's a much more diverse pool of companies that we're looking at and investing in. And I think that's very important in the context of thinking about how this could fit with another allocation or existing allocation that might be a bit top heavy towards the tech space at this point in time.
Great, thanks. We might pivot there. We obviously also manage an all cap portfolio, which has an allocation to SMID, but I just thought in the interest of time, you might want to share some changes and that you've made to the portfolio over the last half and, thoughts about going forward as well in the all cap space.
Sure. So just really, I'm conscious of time, but the changes we have been making, we have been paring back our exposure to those mega cap tech names, particularly in the last 2 to 3 months, because they have got very expensive. And we have been adding to the small mid cap part of the portfolio that represents a bit over 40%, as you said. And then the other pockets would be the consumer staples and healthcare parts of the portfolio, which have lagged quite a bit, more so because they're low beta parts of the market that haven't been working, in this type of market environment. And then really importantly, I think this is important. We have been finding new positions to bring in. And to me, that's always a sign of a healthy market, healthy conditions for an active manager, is that when you're still getting good buying opportunities and names that you like. And that's really, that's for us, that's great. I mean, you get worried when there's nothing to buy as an active manager. That's when you start getting worried. But we're finding these opportunities, companies like ADP, which we've owned in the past, Advisers Wholesale, which is like a mini version of Costco, Motorola Solutions, which has got an interesting franchise in the first responder part of the market, MSCI, great franchise, Paylocity, Thermo Fisher. So again, we've been relatively active in terms of taking profit and reallocating capital into different opportunities really really work well in the next 2 to 3 years. Sorry, James, you go.
And I think it's good just to see that there's different, styles within, the quality bucket, but we're not just focused on one. We've got names that are, traditional growth, and, look to move the portfolio where appropriate.
Yeah, and I'll maybe just following up on that. The one point I would make is if you think about the growth bucket now, like in terms of what we're doing, we're effectively taking profit there. We're moving left, moving right, and a little bit up into the more SMID cap sector. So it's a bit similar to what we were doing around Q2 of 21 when growth caught fire and then fell in a hole last year. So we're basically we've just dusted off that playbook and we're effectively doing it again, because we do feel like there'll be some, quite a few different areas of multiple or sort of mean reversion within the markets. Just the following slide, just really quickly, I'm not going to go through every slide, but it does point out that our relative exposure to healthcare and staples is probably the highest it's been in quite some time. And that's more because of the relative valuation opportunities now are far better than what they've been for quite a while. And then the only other point I'd make is in the top 10, there's a distinct skew towards names where we feel that the valuation has become particularly compelling. And some of them quite a few of them have lagged a little bit in the first 6 months of this year, but we're steadily putting more and more capital into those names that we can see rebound quite well.
Do you want to go to the next slide at all?
Yeah, performance is sort of self-evident. The last 6 months, it's really been lack of exposure to a couple of those giants that's probably weighed on us a little bit. SMIDs have lagged a little bit, but so that's no sort of huge surprise. But again, a lot of the names we own have been doing very well, and we think that will sort of we're actually pretty well set up to see some good mean reversion. The absolute performance has been strong. We're obviously up, around 20% over the 12-month period. Had a good absolute period in the first 6 months. So as much as we're lagging a touch, we've still generated pretty good returns in the last 12-month period. And then the last point I'd make on the Bell Global Equities Fund on the next slide is that we think we've got very good diversity in the context of where the alpha is coming from. So these are just the better performers over the different time periods. But again, it's not literally just a replica of, half a dozen tech names. We're getting alpha from SMID cap names, from healthcare names, from some tech names, a lot of consumer names, and that's exactly what we want. We want to see a sort of broad church of performance.
Which you've achieved, which has been great. Yeah. And then I think on the we might do the same type of analysis just on the SMID portfolio. Yeah. Some of those names are probably unknown to a number of clients, but good to just kind of walk through a handful. And it's good to see that in the all cap portfolio you're certainly overweighting SMID, or going a little bit higher than what you have in the past. So really interested to hear more.
Sure. So in terms of trading activity, again, we touched on some of those winners for the first 6 months of the year. We have been taking profit in those names. First of all, we were adding to them when they were very out of favour. Importantly, we didn't throw the towel in. We felt that the market was probably getting overly negative in some cases, not recognising the extent to which the earnings could recover post this quite odd sort of post-COVID period. Now we're going to a period of normalisation. But yeah, we've been taking profit because the positions have got quite big as they've rallied after adding to them. For the first time in a while, we've also been skewing a bit more towards the small cap names, between smalls and mids. So for people who know us pretty well, you would have heard us talk about the idea that we've been finding better value, better opportunities in the mid cap area of the market. We're starting to see more and more names in the smaller cap end now, which is really encouraging, which is great. And again, it's a sign that the market in and of itself, outside of those 7 names, hasn't been as great as you would otherwise think. And so we have been adding, more recently, names like Advisers Wholesale. I touched on MSCI Paylocity. They're not all necessarily tiny. but we've also introduced a few other things. Advanced drainage systems was a small cap we introduced in Q1. Auto Trader in the UK, which is it's not the same, but it's similar-ish to car sales. So more and more of these companies in that 10 billion and below range are starting to look quite interesting. We're getting better buying opportunities there. So we're lowering that market cap a bit, which is good. And by the same token, a few of those names are getting a bit too big now. So the likes of Arista is getting to the point where it'll be above our threshold. So we'll have to reallocate capital elsewhere. But for the most part, I think that the portfolio is extremely well positioned. The companies, most importantly, are delivering great results. In terms of the recent headwinds that all companies have faced, pleasingly, a lot of like things to do with like inflation, a lot of the supply chain disruptions are also starting to move into their baffles a bit more, into the background. The macro environment is not as bad as what everyone thought. We're obviously being a bit more cautious about the consumer, but if you think about the portfolio as a whole, we feel like it's very well positioned. These companies are all very strong, and we think will continue to do well. Not too much change from a sector and regional perspective. Again, we're probably finding better relative valuation opportunities in EMEA. So more the European countries, and as we've been taking profit in the US, Asia's still tough. We still find it hard finding names in developed Asia to get too excited about. But for the most part, the portfolio is sort of doesn't look that different from a sector and regional perspective as what it might have 3 months ago. And then I guess from a performance perspective, again, it's like the asset class that I've touched on. I mean, it has lagged, notwithstanding that we've still generated reasonable returns, sort of 16.7% absolute return over 12 months, a bit over 10% for the first 6 months. And over the last 5 years, we've managed to outperform quite well in what's been a fairly subdued environment for the asset class as a whole. So I think all things considered, we're relatively pleased with how things have played out thus far. And again, the following slide tells a similar story to that of the Bell Global Equities Fund, which is that, and just a reminder, all these small mid-cap names are all in the other fund. They're all in the Bell Global Equities Fund also. But again, it's a diverse list of names and that have driven the performance, and which has been great. It hasn't been overly skewed towards one or two names or themes also. So those are, I guess, the key points I'd really touch on.
Excellent. Well, Ned, thanks. That's kind of the formal part of the presentation concluded. So again, please keep sending your questions through. We've had some people submit questions before, Ned, so I might just start with a couple of these. And I know we've heard this a number of times, but it'd be good I think some people might have not heard it before, but how does an Australian-based investment team gain on the ground insight into foreign markets? And so the person written here, cultural language understandings and site visits that alike. So that's the first question. So thoughts around it being an Australian-based investment team covering global stocks.
Yep, no, that's a good question. We have had it before. I think it comes down to experience and traveling a lot, frankly. So we've got, the investment team currently consists of 9. We've got 1 new starter starting this next month, so that'll take us to 10. Average experience is a bit over 20 years. So as a team, we've been investing in global equities for all of our careers, basically. So the collective experience in global equities is huge, but you do need to. But it's a good point. You do need to travel, and we'd be conducting in the vicinity of 14 to 15 research trips a year, a bit over 500 research engagements. But it's a very valid question, because the way the companies are managed in different parts of the world is very different. So Japanese management teams are very, very different to others. So they manage their companies in a very different way. They're not nearly as focused on the shareholder. They tend to hold way too much cash. And they tend to they'll sacrifice profitability if it means they can retain market share. So that's like a very unique dynamic to the Japanese market that you do need to understand, and you can't do it unless you've just got the experience doing it. I often joke that German management teams are extremely conservative. US management teams are extremely aggressive. So you do need to understand these nuances because they are really important. And but I think in terms of location itself, in a way, it's not that much different to being. I mean, if you're based in Edinburgh, and we all know there's some great managers based in Edinburgh, they're just as far from Japan as I am from London. So there's I think the challenge or perceived challenge of location is faced by all managers, irrespective of where they're based, in my view.
And I think also your history of the team and your experience as well shows that, I think experience plays a long part, because a lot of these thematics and changes are very slow or they're cyclical. So you've seen them before, and it's just about having that idea around how those management teams would respond in certain environments, right?
Yep, correct.
And then further to that, how do we think about markets, and do we screen out markets due to poor transparency or regulation risk, just to remove those elements from the portfolio?
So I'm going to take that as an emerging markets question.
Yes.
So we don't invest in emerging markets for that exact reason. So for the Bell Global Emerging Companies Fund, the SMID Cap Fund, we simply don't invest in emerging markets at all. And what we've in the all cap strategy we can, but we've not invested in emerging markets for I think 6 or 7 years, any companies, and it's for that reason. It's for the fact that the overall transparency is generally awful, and it gets very, very difficult for us to get confidence that you can actually invest in those companies. I think if I was to pivot to the developed markets, there's no market that's overtly screened out for that reason, but there are some that are better than others. So I would say that Japanese companies, it's not great. The level of disclosure isn't fantastic. That is a challenge that does make it a little bit more difficult, and there's probably the willingness of them to be as open as they could be is not ideal. That'd be the one developed market I'd probably touch on. But for the most part, because we're a quality manager, we've got such high quality filters. The companies that sort of don't necessarily stack up from a transparency perspective are screened out pretty quickly anyway, and we frankly don't spend too much time trying to get ourselves too wound up or frustrated about them.
Okay. Well, this question I think you kind of half addressed in a few responses at our webinar today, but can you walk through why quality as a factor, which makes sense, which we've gone through recently, but we're getting a lot of people saying there's indexes out now that we can, go by the quality factor and do it that way.
Yep.
You have addressed through the webinar, but why is Bell's quality style a better approach?
It's a really good question, and I think it comes back to the idea that do you want to take an active or a passive approach to quality? Because the problem with taking a passive approach to quality now is that you end up with a lot of unintentional stock-specific risk. So I'm looking at right now. So if I'm looking at the top 10 constituents of the MSCI Quality Index, it's NVIDIA 5.3%, Apple 5.25%, Microsoft 5%, Meta 3.5%. So these names are all at 52-week highs and outrageously expensive. So if you go with a passive interpretation now, you are now the proud owner of a portfolio of really expensive stocks. They're really good companies, but they're really expensive. And I think you need to think about that old sort of saying that you can do just as much damage, paying the wrong price for a great company as you can by investing in a lousy company. And I think that's really the decision. Whereas an active approach like ours or another manager is one whereby we're looking through the prism of a broader universe of companies, like different flavors of quality, and we can be more nimble. Like, we can take profit, we can move, we can dive down into areas of that quality universe that are they're undervalued, and there's better opportunity to make money. Whereas the indices just don't. The indices work the other way. So the more expensive those companies get, the more weighting they represent in that quality factor, which is the complete opposite of what you should be doing. I mean, the way these things work is such that it's the complete opposite of the way a normal investor would operate. You don't buy more of what you've got after it's become more expensive, unless you're itching to lose money.
Agreed. I think the methodology needs to be looked at, and that's why being active makes sense in this space. And then obviously macro has driven a lot of investors' thoughts and probably process. And this question goes through, have you made any meaningful changes to your investment process through this period of higher inflation and higher rates?
Yeah, it's a good question. We haven't changed the process in and of itself, but so of our quality factors, one of our 6 quality factors is business drivers. And part of the business driver element comes down to macro conditions facing markets and companies. And so clearly when there is such extreme macro events as to what we've seen in the last 18 months, that causes us to focus a little bit more on the business drivers and the extent to which that's factored into earnings. So we're not changing what we're doing, but we're emphasising a part of the quality recipe, if you like, because it draws so much attention. Because if you're thinking about in the pre-COVID period, we had 10 or so years of almost zero interest rates and pretty strong but very stable GDP growth. Now that's been completely, obviously we've had, huge interest rate increases, huge inflation. So you definitely pay more attention to it. I think the only thing that comes out at the end is that it'll tend to it doesn't really change that much, really, because in a way, as a quality investor, our whole intention is to avoid companies that are they have big macro risks. Like value names, for example, generally have a lot more macro risk. They have, they're much more exposed to GDP growth. They've generally got much more leverage. Whereas we're intentionally trying to skew those names out a little bit. The only area where it probably does come up a little bit is where, for example, the outlook for the US consumer, where we've been a bit more apprehensive for the last 12 months. And so that's dictated less conviction in some of those names, and therefore less representation in the portfolio. But I think for the most part, our companies, they've got very, very low degrees of leverage. And that's a really important part. That's probably one of the biggest factors of the overall. So if you think about quality, it's generally dictated by leverage, return on equity, and growth. So the leverage part of that puzzle, i.e. how much debt a company's got on its balance sheet, has not really been probably accurately priced in markets yet, because it's really been growth, for the first 6 months of this year. But what we are seeing, we're seeing more and more corporate delinquencies. Like, that's picking up very materially now. And I think that's a matter of time before markets more generally pay, like the spotlight on corporate leverage really starts to amplify and pick up, and companies are either punished or rewarded based on their leverage.
Right. Well, I think that's certainly going to be a playing factor going forward, and we'll see that in headlines. Now, Ned, I just wanted to say thanks for your time today and for the insights that you've shared what has been another volatile year. And again, any questions that you have, please feel free to reach out to myself or any of the Channel Capital representatives that you can see on your screen. Again, thank you for today, Ned. Thanks again. And I look forward to seeing everyone at the next update.
Great. Thanks, everyone. Appreciate it.
Goodbye.